All right, let's jump right in. Today, we're basically acting as a specialized analytical engine to totally deconstruct an incredibly comprehensive anonymous expert report. We're looking at one of the single most powerful financial mechanisms in the entire tax code, 100% bonus depreciation. Now, we aren't here for surface level stuff. We're going to deeply analyze the mechanics, the cause and effect relationships, and the advanced strategic applications of this newly restored provision. We'll be looking at exactly how top-tier financial strategists use this to radically alter the trajectory of their wealth.
I want to anchor you immediately with this number right here, 100. As of early 2025, the ability to completely expense qualifying business assets in year one has been fully reinstated at 100%. We are talking about taking massive capital investments, things that typically take decades to recoup, and instantly turning them into first-year deductions. It is quite literally an immediate dollar-for-dollar reduction of your taxable footprint.
Okay, let's look at the addenda for this explainer. 1. The mechanics of bonus depreciation. 2. Core eligibility parameters. 3. Strategic real estate optimization. 4. Alternative asset classes. 5. Active income offsetting. And 6. Strict compliance. Starting with Section 1, the mechanics of bonus depreciation, the core financial engine.
So in a strict financial context, what is this? Well, bonus depreciation is an incentive that lets you immediately deduct a massive percentage of an asset's cost in the very first year. And the core insight from the report is that this radically shifts an investor's reality. Instead of slow capital recovery over decades, you're engineering an immediate, highly powerful cash flow injection. You buy the asset, you put it into service, and boom, you capture the capital deduction right now, taking full advantage of the time value of money.
You can really see the stark contrast here. Under traditional depreciation, the system kind of forces you to spread your deductions slowly. Sometimes you're tying up your capital for up to 39 years if it's a commercial building. Bonus depreciation disrupts this completely. By accelerating a multi-year deduction into year one, you drastically lower your immediate taxable income. And what that does is free up real, liquid cash flow that can be instantly reinvested into new assets. It basically acts as a compounding accelerator for wealth. Now, this is why this expert report is so incredibly timely. Previously, financial models had to account for a pretty severe, scheduled phase-out. The deduction was slated to drop to 40% in 2025, plummet down to 20% in 2026, and vanish entirely by 2027. But recent 2025 legislative updates restored this deduction permanently to its full glory of 100%. And because of this, financial strategists can now project massive upfront write-offs with absolute long-term certainty, which lets them lock in those multi-year investment plans. Moving on to Section 2, Core Eligibility Parameters, the implicit assumptions. Okay, what's really interesting here are the non-obvious facts detailed in the report. First off, personal use or hobbies, they absolutely disqualify an asset. It must be used more than 50% for business purposes, and you only get the deduction proportional to that exact business use. On top of that, the asset must be tangible, it must be depreciable, and crucially, it has to have a statutory recovery period of 20 years or less. So no, you cannot use this to write off the raw structure of a 39-year commercial building. But, as we're about to see, you can surgically extract the qualifying components inside it. Which brings us perfectly to Section 3, Strategic Real Estate Optimization, Accelerating Property Deductions. To bypass that traditional 27.5 or 39-year wait, experts rely on a highly precise engineering process known as cost segregation. Step 1, obviously, is acquiring the property. Step 2 is conducting the cost segregation study. And listen, this isn't just a clever accounting trick. It is a literal engineering report that deconstructs the physical property into individual pieces. Step 3 isolates the assets that have that sub-20-year lifespan. We're talking specialized plumbing, appliances, cabinetry, flooring.
Finally, step 4 applies the 100% bonus depreciation directly to those specific, isolated, short-lived assets. Let's actually put some numbers to this to see the mathematical reality. Imagine a $1 million apartment building. An engineering study might determine that 75% of the value is tied up in the physical building structure itself. That structural shell stays on a slow, decades-long depreciation schedule. But 25% of the value, or $250,000, is tied to those short-lived assets. Because of the restored 100% bonus depreciation, that $250,000 becomes an instant year-one tax deduction. It's a massive immediate write-off. All right, Section 4. High-impact alternative asset classes beyond the building. The analytical scope of this report proves that this mechanism is incredibly industry agnostic. It's really not just about buildings. If you acquire heavy business vehicles, specifically trucks and SUVs with a gross vehicle weight rating over 6,000 pounds, they qualify. Industrial equipment, things like CNC machines, manufacturing robotics, forklifts, all qualify. Even highly unconventional, heavily capitalized investments like Bitcoin mining rigs and tangible drilling costs in oil and gas fully qualify, provided they are structured and run as a legitimate business operation. And here is a crucial insight. Top-tier financial strategists don't just use one tax code provision, they stack them. By combining Section 179 expensing, which allows for immediate expensing up to a certain dollar limit, with 100% bonus depreciation, businesses can effectively zero out the cost of massive asset acquisitions in year one. This synergistic deduction is incredibly powerful, especially for heavy vehicles and heavy machinery. But it comes with a strict caveat. The burden of proof is entirely on you to meticulously maintain business use tracking and mileage logs. Section 5. Active income offsetting strategies. Generating wealth from paper losses. I want you to pose this critical analytical question to yourself. How does a non-cash paper loss, like the on-paper depreciation of a building's roof or the immediate write-off of an industrial machine, actually generate tangible, immediate wealth? The answer lies entirely in how that paper loss shelters the real, liquid cash you are actively earning somewhere else. If you are a high-income earner, particularly someone sitting in that top 37% marginal tax bracket, a massive first-year paper deduction yields an unparalleled return on investment. Let's say you write off $100,000 worth of equipment or short-lived property. Well, that paper loss just saved you $37,000 in actual cash taxes. That is $37,000 of immediate liquid wealth generated entirely from a non-cash paper loss. It's huge. But there is a massive statutory hurdle here. By default, IRS rules dictate that passive losses, like those generated from traditional rental real estate, can only offset passive income. You cannot normally use them to shelter your high-earning W-2 or 1099 active income. However, the expert report details two very advanced workarounds. Exception 1 is the real estate professional status, or REPS. This requires logging 750 hours in real estate trades and proving material participation. Exception 2 is the short-term rental strategy, where the average guest stay is 7 days or less, again, coupled with material participation. If you successfully execute either of these rigorous exceptions, those massive paper losses cross the boundary. They can now completely offset your active W-2 or 1099 earnings, effectively zeroing out your active tax liability. And finally, Section 6, strict compliance and audit defense, the non-negotiable fail-safe. This quote right here from the expert briefing serves as a pretty blunt warning. Massive upfront deductions, which can sometimes wipe out hundreds of thousands of dollars in taxable income overnight, will absolutely trigger algorithmic scrutiny at the IRS. The agency fundamentally views this as a quote-unquote high-impact deduction. Therefore, strict bulletproof compliance isn't just optional, it is the ultimate cost of entry into this level of wealth strategy. Surviving an audit isn't about luck. It's a defensive strategy built entirely on evidence. The report mandates that without meticulous usage logs proving over 50% business use, without clear, itemized purchase invoices, without validated in-service dates, and without professional cost segregation engineering reports, your deduction will be denied, and you will be hit with severe penalties. Your documentation is basically the ticket stub that proves your fast pass to tax savings is mathematically and legally legitimate.
The tax code is not just a list of rules, right? It's a complex incentive system explicitly designed to legally reward those who build, acquire, and invest. So I want to leave you with this final thought. Are you proactively engineering your wealth strategy by deeply understanding the implicit mechanics of these provisions? Or are you merely reacting to your tax liabilities after the fact? The analytical tools are right there. The permanent 100% bonus depreciation is active. It's up to you to apply the analysis. Thanks for joining me on this explainer, and keep learning.